Let's move the conversation back to the market, bring in Courtney Garcia of Payne Capital Management, John Mowrey of NFJ Investment Group here with us at Post 9. It's great to have both of you with us. John, I'm going to go to you first. I mean, Marco is not willing to say all's clear. It's time to be positive. You've been overwhelmingly positive, arguably the most positive person who sat on this desk with me. Are you moved at all by what he said?
A little bit. What I would say is particularly large growth is looking less attractive. There's no way around that. Semis in particular look rich to us, but it's not just technology. In the value space, home builders look egregious too. We've exited all of our home builders and we've reduced semis. What I would say in terms of the AI frenzy, this could go further. I had one of our analysts go back and look at what Intel got to as a percentage of the S&P 500 in 2000. And the answer is 3.8%. If NVIDIA gets to 3.8% of the S&P 500, that's another 40% to go. That would take it to a $1.4 trillion market cap. So there's precedent for the semis continuing to move higher if you look at Intel. But what I would say is that investors should be relaxing exposure to large growth, technology, and those areas. What I would pivot to is there's a gift. We have a gift, Scott, and that's value, mid-value and small value. You've got steep discounts. The Russell 2000 value is trading at just 10 times earnings. The S&P's at 18. The Russell mid-cap value is at 13 times earnings. We just looked this week and we said, okay, let's go back historically to the late 80s and see every time that the triple Qs on a 3-month basis have beat the Russell mid-cap value by 15%, which is what just happened, what is the subsequent returns for the mid-cap value space? And they kill it. 88% of the observations, which there were 16 total, you saw the mid-cap value space handedly outperform on an average basis of 15% per year for the next 3 years.
Yeah, but you want people to make a leap of faith that there's not going to be a recession, that the leading economic indicators are wrong, and that we're not going to have a more dramatic economic slowdown, because otherwise, why in the world would I want to buy any of that?
On the contrary, I think a recession is entirely plausible. If you look at the inversion between the 2-year bond and the Fed funds rate, you've got that as wide as you've seen historically, and that's typically been associated with a recession. But there's a lot of discounting that's already occurred, Scott. If you look at the banking sector, you've got the recession priced. If you look at consumer discretionaries, you have the recession priced. If you look at real estate,
consumer discretionary is like the third best sector of the year. What do you mean it's
not
priced?
at the value arena? You don't have Tesla and Amazon. I mean, that's in the growth bucket. If you look at apparel, if you look at some of the other areas like mobile home, Winnebago, Thor, those are steeply discounted. So you've got opportunities. I mean, Lululemon's one that reported very well. That was very beaten up. So you're seeing opportunities in the discretionary space, but I would point to REITs. I would point to banks. I think those are particularly interesting here. The yield premiums on those, Scott, are material relative to the 10-year, and you're getting dividend growth. So we're bullish on those cyclical value areas. I would be moving away from large growth and tech at this stage of the cycle. I don't think that's as attractive.
Court, the floor is yours.
Yeah, and I'm kind of going to build on this, too, but I do agree with that, where really what you're seeing right now are these stretch valuations. I mean, they're essentially at nosebleed levels right now. You have Amazon trading at 70 times earnings, NVIDIA at 50 times earnings. Apple looks better than that at 27 times earnings, but even that's 50% above its 10-year averages. And just realistically, I don't see that continuing, even though people are rushing into this as the safety trade, so to speak. But really what we want to see is not just these top 8 companies outperforming the markets. We need to see a larger breadth in the stock markets and other categories doing well. And last week we finally saw that, which actually I think is a really good sign. We were seeing general sectors doing well. So I do think there's plenty of areas. I do like value, just to kind of hone on that. And especially, too, with the banking sector, got hit really hard with the banking crisis, which does seem to be subsiding. I think you're probably going to start to see that leading some of the other charges here. And there's plenty of opportunity even in international or emerging markets.
All right, let's